Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. I have a singular big picture item here on this daily chart that is over 2 years old. It is the big June/October 2022 to April 2024 bear channel, currently at 204 to well off the bottom of my daily chart. This bear channel is still highlighted in dark blue on my daily chart, and it has been only since mid-April this year that we have seen it broken on the upside. Yet even now it is still so significant I've decided to keep it highlighted and also still keep it on my daily chart. So, on the 22nd of April, prices punched up through this dark blue highlighted upper bear channel line and moved higher, up to arguably the most difficult overhead congestion between 267 to 270, where the market was capped at the end of May. In the process of moving higher, the market created a very steep and very acute late April to late May bull channel, highlighted in purple on my daily chart. So before I deal with this bull channel, let's go back to that break of that big old bear channel. The break higher gives a primary target X for the move up in the 277 area, the secondary harder to reach target X1 up in the 312 area, which is up off the top of my daily chart right now. So what stopped it rising and turned the market into a V-top? Well, it was that 267-270 resistance area. I had repeatedly said how this resistance is quite reasonable and quite congested. And now draw your attention to the exit out of the purple highlighted bull channel and into a new pattern, a pink highlighted June based, quite acute bear channel, currently 222 to 238, leaving behind a V-top in late May. The move lower has been as dramatic as the rise, perhaps more so, and still is, today. I spoke on this 3 weeks ago, where I said, and I quote, how this, and I quote, gives us some new opportunities on the downside, but ruling out the larger, longer term potentials on the upside. You could call this all a possible diversion, if you will. Thus we have a potential primary target X2 down in the 244 zone, and a secondary and harder to reach target X3 down in the 233 zone. In theory, even dropping down to target X3 at 233 would still keep targets X and X1 above still alive, but I imagine we might have developed some newer patterns by then, should prices venture that far. End of quote. Last Friday, prices reached the primary target X2 at 244 on the downside, and today we have managed to reach down to the lower secondary target area X3 at 233. I was not completely comfortable with an easy move down to target X3, as I said 2 weeks ago, and I quote, between the primary target X2 and the secondary target X3, we have some considerable supports, which I had highlighted earlier when the market was moving higher, notably the bright red neckline extension, currently 236, the green and rising short medium moving average, currently 243, as well as congestion at 234, 238, 240 and 242. End of quote. Well, this week the market attacked the downside from the start, and I use that word attacked advisedly, as prices gapped open lower this past Friday, pushing lower all the time, and we are pushing lower even now, with a possible unusual key reversal down today. Below, we now have the flatlining gold highlighted long moving average, currently at 229, and a slowly rising medium moving average, currently 225. But an obvious area of support is further below, starting at the 50% absolute Fibonacci line at 219, and mainly centered around the old descending triangle and bullish halfway hesitation from April between about 213 up to the 50% absolute Fibonacci line. However, I only point out this as an obvious spot, not necessarily a strong spot or support. For that, well, you would have to go down to the original feature that started this whole late April to date action, and that is the dark blue upper bear channel line, and that's currently at 204. Minneapolis wheat. My apologies for some of the labels being highlighted in bright red on my daily chart. Sometimes my charting system throws a wobbler and does this sort of thing unintentionally. So please note there is no special meaning in any of the labels being highlighted in bright red. So back in late February 2023, and especially at the start of April last year, so that is now outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what is now highlighted in dark blue on my daily chart, a descending expanding wedge pattern, currently 713 to down well off the bottom of my daily chart. The upper trend line is currently escorted and reinforced, and has been for some time, though not very well recently I have to say, by the declining long moving average, currently at 710. And going back a bit to early December last year, the short medium moving average, currently 698, started capping prices. In truth, this moving average had been an effective cap on the market since mid-October 2023. Not tested, but effective nonetheless. However, on the 22nd of April, after some base building since late February, the market broke higher over the short medium moving average, as well as the medium moving average, currently at 682, and some other significant resistances in a band between 693 to 708. In this band, we also had two other patterns I spotted earlier, nestling like Russian dolls, one within another. 33 weeks ago, that's how long ago, 33 weeks ago, I said the following of the first pattern, highlighted in purple on my daily chart, and I quote, "It is the nascent late August, that's late August 2023, the nascent late August to date bear channel, currently 6682, well off the bottom of my daily chart." Once again, I note how we have a smaller bear pattern nestled within a much larger one, much like a Russian doll, end of quote. The second pattern is no longer highlighted and is the October 2023 to late April 2024 bear channel, currently 568 to 670. This pattern had seen some touches and likewise was also broken. Prices 4 weeks ago exited up and out of the 693 to 708 congestion band, creating a steep, acute and ultimately short-lived late April to early June bull channel, highlighted in bright red on my daily chart. This original break higher gave me the opportunity to consider opportunities topside. Thus, for the big dark blue expanding wedge pattern, we have a primary target X in the 878 area and a harder to reach secondary target X1 in the 928 area. This second area is well up off the top of my daily chart. For the purple highlighted bear channel, we had a primary target in the 777 area for secondary harder to reach target X3 up in the 820 area. The primary target here was just about achieved. For the unhighlighted bear channel, both the primary and secondary targets had been previously reached. So I'll just let that all sink in for a few moments, and then we'll look at the obstacles that prevented the market reaching those harder primary and secondary targets. What will lead me now to retiring actually those unfulfilled targets topside, and what turned the market lower at the end of May. First off was the capping of the market 3 weeks ago, and that was by the July 2021 low at 778. Initially it didn't look that aggressive, but this resistance stopped the rise and turned the market lower, back down within the dark blue descending wedge pattern, back below the long moving average, and down through many supports that are now resistances. Last week prices dropped down below the short medium moving average and the medium moving average. Medium moving average is currently at 685. And as I said 2 weeks ago, and I quote, we could easily see prices head back down to the purple upper trend line, currently at 662, as this is the area where we have a wide congestion band formed over February to April between roughly 640 to 675. Now, should we get down there, then it would not be the end of the world for any previous break higher, though it would indicate that the April to June move higher was, for at least the large dark blue descending wedge pattern, a false break higher, and possibly for the purple one, a limited fulfillment of just the primary target. I further added, and I quote, but I think it would be best to see what the markets construct should we get down there before totally retiring those big topside targets, end of quote. Well, we are down here now, and we got down here by a feature I noted last week that is still in operation. It is a June-based, very narrow, very acute and small bear channel, currently 584 to 638, highlighted in bright pink on my daily chart. I commentated on this last week and thus, and I quote, "There's only one way to go for this pattern, and that is down, as it is so narrow, and I'm wondering if the market has the discipline to keep within that bear channel," end of quote. Well, the market has had the discipline to drive down that very narrow and acute bear channel. And what has been surprising is how prices had sliced down through the congestion formed over February and April between roughly 635 to 676, as if it wasn't even there. The market is now down towards the October 2018 high at 611, the April 2021 low at 606, and perhaps most interestingly, the green highlighted September 2019 to date uptrend currently at 597. This last one, perhaps the best looking of all these three, and the most crucial. You see, below this green uptrend, we really don't have much support until the December 2021 low at 542. And it also ties in with what ultimately is likely to be the big picture pattern here created since February, so for about the last 5 months. And that is that the whole action being an inverted diving board pattern, a pattern that I have seen duplicated in some of the other grain markets, but one that has not been as advanced as here. I suspect that, like so many times in the past, Minneapolis wheat today has been a leader showing what eventually will happen in the other grain markets. London UK feed wheat. One of the key features of my daily chart, and this is a surprising feature, has been the extension of the neckline of the May to June 2023 reverse head and shoulder spot. That's currently at 192.85. Originally this was not a very notable pattern, a mini reverse head and shoulders pattern if you will, but the extension of the neckline first acted as a pretty reasonable support and more recently as an additional resistance. Though I suspect in the background the September 2021 low at 181.70 and perhaps more importantly the 50% absolute Fibonacci line at 180.5 had helped in the past to prop up prices now this year in late April, however briefly to cap prices before possibly acting 2 weeks ago as a temporary support. Looking at the more recent action, we had a double bottom during February and March with prices moving up thereafter through the old congestion from March to April 2019 between 161.95 to 165.75, as well as the July 2021 low, July 2021 and May 2023 lows, both at 164 even, and the August 2020 low at 161 even, and reaching the target area for the double bottom in the 170 region. We then had some hesitation under and around the mauve highlighted medium moving average, currently at 173.25, between mid-March to mid-April. The mauve medium moving average had been an effective cap for the market since about late 2023, becoming more significant as we headed into December 2023. In April, this cap became an ascending triangle, and from this pattern, prices punched up higher. On the 22nd of April, reaching both the primary and secondary targets above for this pattern. However, the market then came into contact not only with the 50% absolute Fibonacci line and the September 2021 line, but also with the slowly declining long moving average, and that's currently at 179 even. At the end of the first week of May, prices punched up through all three of these resistances, establishing itself over all of them. This left just the previously mentioned neckline, or rather, the neckline that is over a band of congestion formed between roughly late August 2023 to early January 2024, between about 183 to 189. I said 6 weeks ago, and I quote, "I'm not sure how good this band of congestion really is, and I'm also not sure how good the neckline is as a resistance without the help of the 50% absolute Fibonacci line and the September 2021 low. But having come so far, it would be wasteful to not look further higher. Thus, looking at the triangle as a halfway hesitation, we could see a potential up as far as just under the neckline and above the 183 to 189 congestion up in the 190.75 area." End of quote. Prices made a forced but significant break higher 5 weeks ago, and then 3 weeks ago. 3 weeks ago, they made a truer break upwards, up through the August 2021 high at 199.20 and peaking just under the March 2013 high at 205.05. Now, I said a few moments ago how the break 5 weeks ago was forced but significant. The reason why was because it helped define an early March to early June bull channel, highlighted in purple on my daily chart. And though it was part of a weekly key reversal down, the action 3 weeks ago justified that weekly key reversal down as a false break. Then last week the market broke down lower, down through the purple lower trend line and the dark blue neckline, virtually at the same time, as the market could not break higher through the top of the purple upper bull channel line and through the March 2013 high at 205.05. They created a sharp V-top and very late May to date bright red, very acute and narrow bear channel. That's currently 157.40 to 167.75. As I said 2 weeks ago, when the first break below the proper purple bull channel and dark blue neckline combination happened, and I quote, "It's now up to the market to exploit that move lower. If it does, it will not only have to overcome the previously mentioned congestion between 183 to 189, but also the congestion below between 179.70 to 181.70, which contains the long and short medium moving averages, as well as the September 2021 low and the 50% absolute Fibonacci line. My current view is that despite the congestion seen back between roughly late August 2023 to early January 2024, that it will be the lower congestion that is the more serious." End of quote. Well, prices took on all of those congestions and shot through them and then some, such that we have today just edged below that small hesitation zone that became the small bullish ascending triangle back in April, roughly between 168 even to 174. We are now just below it. I spoke on this last week when I said, and I quote, "Will we hesitate here again, but this time on the way down? Possibly. But the overhang of the market is bigger than this old ascending triangle, and I'd suggest looking lower, down to the old double bottom of February and March, and below the congestion and lows you can see on my daily chart between 161 even to 165.75. The only counter to this is that the bright red bear channel is very narrow and very acute and very susceptible to an easy breakout." End of quote. Everything in that statement made last week still holds true, and I will only add this additional comment, formed by my analysis, oddly enough, of Minneapolis wheat, and that is we might just be forming, much as in Minneapolis wheat, an inverted diving board pattern for the action from at least mid-March today. So watch this space. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.